Welcome back to day 6 of your trading journey. By now, you've got a solid foundation. You understand candlesticks. You've seen support and resistance in action, and you've discovered how patterns can reveal the next move. But today, we're going to the next level. Today, I'll introduce you to the tools that help traders catch breakouts before they explode, reversals before they crash. We're talking about indicators. Think of indicators like sensors in a car. They tell you when to speed up, slow down, or hit the brakes. They won't drive the car for you, but they'll make you drive a whole lot smarter. Let's explore 4 of the most powerful indicators every smart trader uses. Moving average. To understand the trend, RSI. To catch overbought or oversold zones. Bollinger Bands. To measure volatility and spot explosions. Stochastic. To time your reversals precisely. Let's start with the simple moving average, or SMA. Have you ever looked at a chart and asked yourself, is the price really going up, or is it just bouncing around? SMA helps you answer that question fast. It takes the average of the last few candles and shows it as a smooth line on the chart. You can choose the average to be taken over 10 candlesticks, 20 candlesticks, 50, 100, etc. That means we take the average price of the last 10 candles, or 20, or 50, and so on. The higher the number, the smoother the line, and the stronger the trend. So when you see MA20, that means the line is created by taking the average of the last 20 candles. Now here's the real power. The most important and most simple way to use the moving average is to determine the trend. It's more simple than you think. Write this down. If the price is over the line, the market is trending up. If the price is under the line, we're in a downtrend. Let's try this. Add a 50 SMA to your 1-hour chart. When the price is above the SMA and the line is rising, that's an uptrend. When the price is below the SMA and the line is falling, that's a downtrend. That's the simple moving average advantage. It keeps you trading with the flow, not against it. By buying when the price is over the line and selling when below, you increase your chances of success drastically. Another use of the SMA is to spot the start of a new trend, and for that, you can use a few strategies. The most basic and beginner-friendly strategy is this. Use just one moving average, the 50 SMA. When the price crosses it, there's a high chance of strong momentum and a trend change. You can use this method for any product, commodity, FX, or index, and for any time frame, 1 minute, 1 hour, or daily charts. Pro traders often use 3 to 5 moving averages. For example, you can plot SMA 20, 50, and 100. Now here's the exciting part. When all those lines cross each other, you've got confirmation that a new trend has begun. This is an amazing tool to enter the trend as early as possible and ride it for high profits. If you're trading using stop losses, moving average levels are perfect for setting them. Here's why. If the price drops below the moving average, there's a high chance the trend may turn against you. Placing your stop loss just below the moving average can protect you from a big loss. It's up to you to choose which SMA to use, 20, 50, 100, etc. The lower the number, the smaller the loss, because the SMA is closer to the current price. So yes, the moving average is simple to use and an extremely powerful tool when used correctly. Here's what it gives you. First, you'll trade with the trend. Second, you'll spot the beginning of a new wave. Third, you'll be able to protect yourself from high loss. Enjoy it. Let's move to the next indicator, RSI, Relative Strength Index. Now let's pump it up with RSI, the Relative Strength Index. With RSI, you can predict before the move if the price is going to go up or down. Extremely powerful tool. It tells you how strong the current move is, and whether it's overheated. And when so, it is highly likely that it will bounce back. Unlike moving average, RSI indicator is added under the price chart. So you see the price chart, and under it you see the RSI chart. RSI is a number between 0 and 100. The theory is simple. When the number goes over 70, it means that many buyers bought bigger quantities very fast. They overheated the market. That's why we say that the product is overbought. In such a situation, the market needs to cool off. So, after the RSI reaches a high number, over 70, the price makes a correction and drops. It's the same logic when RSI drops below 30. It means that many sellers are selling high volumes very fast. They overheated the market. That's why we say the product is oversold. When this happens, the market needs to cool off. So, after the RSI reaches a low number of less than 30, the price makes a correction and jumps. But here's the exciting part for you as a trader. As we said, with RSI, you can predict if the price is going to go up or down. It is simpler than you thought. Write this down. If the RSI is in the zone under 30, buy. If the RSI is in the zone over 70, sell. These zones can be different for different styles of trading. Some traders prefer 25 and 75, or even 20 and 80. This is up to you. As a beginner, start with 30 and 70. Later on, you will find your ideal levels. Open your chart. Put RSI indicator. See, when the RSI goes below 30, for example, to 20 to 25, after that it always goes up to 70. Check a few symbols, a few time frames. And the opposite, when the RSI reaches over 70, sooner or later it goes back to 30, like magic. Together with RSI, it moves and the price. So you can see clearly, when the RSI is too high, the price drops. When RSI is too low, the price jumps. This is an amazing tool that is used by pro daily traders. If you want to have RSI levels live on your mobile, we have a mobile app which can alarm you directly on your mobile when a product reaches 70 or 30. Just type in your app store, Live RSI, and get it. That's a tool every profitable trader has in their pocket. Let's see how to use the RSI for protection. Have you ever opened a buy position and just a while after that the price starts dropping strong? Bad feeling, I would agree. Well, if you had used RSI, you could avoid this annoying scenario. Here's an example. The price has been climbing for some time. You're tempted to jump in. Then you check RSI. It's at 80. That's a red flag. The market is overbought. And sure enough, a few minutes later, the price dips hard. If you had opened when the RSI was 80, you would be in a deep minus or even liquidated. But now you protect yourself from such mistakes. Now flip it. The price crashes down after a news release, everyone's panicking. But you check RSI, it's below 25. This market is exhausted. You wait for a small bullish candle, enter, and ride the bounce up while others are still selling and losing. RSI gives you the edge of timing. You don't chase the move, you can predict it and wait for smart entries. Want to take it further? Combine RSI with your support and resistance zones. If price hits a major support and RSI is below 30, that's your signal. Buy. If the price hits resistance and RSI is above 70, consider sell. Smart traders use RSI to avoid losses and enter with confidence to target profits. If you need more info for the RSI, drop a comment and we will answer. Let's move on to the next indicator, Bollinger Bands. Let's dive into Bollinger Bands, one of the most practical and visually powerful indicators on any chart. Imagine the market like a wave. Bollinger Bands help you ride that wave. You'll see three lines. The middle line is the simple moving average, MA20, the average price over the last 20 candles. The upper and lower lines are called bands. They show how far the price is stretched from the average. These bands expand when the market is volatile and contract when it's calm. Here's the key idea. Price always tends to return to the middle line. So, how do traders use it? When the price touches the upper band, it means the market is overheated. That's often a good time to sell or take profit. When the price hits the lower band, the market is oversold. That's often a good time to buy or prepare for a bounce. It's like a rubber band. The more it stretches, the more it wants to snap back. But be careful. Bollinger Bands work best in normal market conditions, when price moves in a range or gentle trend. In moments of strong news or major events, like interest rate changes or war headlines, the price can break through the bands and keep going hard in one direction. So avoid using Bollinger Bands during high-impact news. But in regular trading hours, this tool is gold. Try this on your chart now. Open a 1-hour chart. Add Bollinger Bands. Watch how price moves between the bands. Use the middle line, MA20, as your gravitational center. Price always wants to return to it. Pro tip. Combine Bollinger Bands with RSI or support chi resistance zones for even stronger confirmation. If price hits the lower band and RSI is below 30, that's a powerful buy signal. If price hits the upper band and RSI is above 70, get ready to sell. Bollinger Bands are like a market heartbeat. They show pressure, tension, and balance. Use them wisely, and you'll always trade with the flow, not against it. Stochastic oscillator. Now let's talk about Stochastic, a tool many pros use to perfect their entries. Stochastic works a bit like RSI, but it's faster and focuses on how the price is behaving relative to its recent range. It also moves between 0 and 100. Above 80, the market is overbought. Below 20, the market is oversold. But here's the key. Stochastic has two lines, and when they cross at those extreme levels, it can signal a reversal. Let's see an example. Price is falling fast, but you see a double bottom forming near support. You check Stochastic, and boom, the fast line crosses above the slow line below 20. That's your reversal clue. You enter. The market bounces, and you catch the move before most traders even notice. Use Stochastic to time entries at turning points. Add precision to RSI or Bollinger setups. Avoid chasing moves too late. When Stochastic and RSI agree, you're stacking probabilities in your favor. Putting it all together, the perfect combo. Here's how to combine these tools for high probability trades. Use moving average to spot the overall trend. Use RSI or Stochastic to find moments when the trend is stretched. Use Bollinger Bands to see if the market is about to move back to the middle line. Combine them with chart patterns, support, resistance, and confirmation candles. Imagine this setup. Gold is in an uptrend, above the 50 SMA. Price pulls back to support. RSI is at 28. Stochastic just crossed up from 18. A Bollinger Band is hit. That's a prime buy setup. You're not guessing, you're aligning the data. Here is a quick challenge for today. Open any chart, preferably one you like trading, gold, oil, NASDAQ, anything. Add a 50 moving average, RSI, Stochastic, and Bollinger Bands. Answer to the following questions. Is the trend up or down? Is the price near support or resistance? What's the RSI showing? Did the price recently bounce from the Bollinger Bands? Are there crossovers on Stochastic? Take a screenshot of what you find, post it in the comments, and our team will give you feedback. This is how you become a real trader, by practicing with real charts and learning what these tools are really saying. If you feel ready to start trading, click on the link below and we'll connect you to a real company. If not, no worries. Your next lesson is coming soon. Just keep learning and we'll keep teaching. Coming up next in Day 7. Real trading strategies. You've got the tools. Now let's put them to work. In Day 7, we'll cover risk-to-reward ratios like 1-to-3 setup, the martingale method, triple hedge techniques, when to enter, and when to walk away. This is where it all clicks. You're not just learning anymore. You're building your own trading system. Let's go. The chart is talking. And now you know how to listen and act.